Recently, I talked about central bank desynchronisation and why foreign exchange and long bonds are where the price action's showing up. Today, I wanted to go one layer deeper because Japan has just given us essentially a very clean example of how this new regime actually works in practice. Japanese long bonds, as I mentioned, have hit levels that we haven't seen since 1995. They're at record highs. They've been surging. And yet the Japanese yen has actually weakened. That feels counterintuitive, but it isn't a paradox. It's the new regime. In the old world, high yields meant a stronger currency. But that was the playbook when inflation credibility was intact, fiscal policy was a secondary consideration. But Japan isn't operating in that world anymore. If we think about what the market is telling us, I think the signal is separate from the noise, and it's simple. Rising yields aren't signaling growth or tighter policy, they're signaling fiscal risk and bond supply pressure. So the government knows it too well, and it's not in isolation from the rest of the G7. Japan is now looking to cut issuance of super long JGBs to the lowest level in almost 20 years. Not because inflation is beaten, but because the bond market has been pushing back, as we've seen a bit of a coordinated sell-off in the long end. This is really fiscal dominance in action. I think what we're seeing across the G7 is somewhat a theme in unison. Governments are shortening debt maturities, investors are refusing duration at current prices, and central banks quietly are accommodating through liquidity management rather than overt quantitative easing. The United States is no exception. If we think about Treasury issuance, it's leaning shorter. The Fed's rhetoric says higher for longer, but I guess the plumbing tells a more nuanced story. I'd say policy is no longer just about rates, it's about keeping the system essentially functioning. Now, I think this matters because Japan sits at the center of global capital flows, as I spoke about previously. And rising JGB yields increase the probability, not the certainty, but the probability of partial yen carry trade unwind. Gradual repatriation by Japanese insurers is a case in point, and high volatility at the long end of global bond markets. So, not necessarily a crash, but certainly pressure in a world where there's a number of macro headwinds to face. So, I think the key takeaways really are long bonds are no longer passive shock absorbers. Indeed, they may be becoming the pressure point. Diversification still matters, but only if you understand why assets are moving, not just because they moved in the past in a certain manner. This is another, I think, whole new world moment for markets, and it requires a different mindset, skill set, and a framework to consider.